Stephen, I want to pick up where Bill Gross left off. He says decent but not great value. Is 5% on the 10-year yield just decent value to you?
You're talking to someone who's been very wrong, because I would have thought that was good value at 4, so yeah. 5 should be even better value. I think we've been wrong for mainly the right reasons. So we need to see these conditions changing that have caused this. So many of those guests pointed out the valuation piece. So real yields are above trend GDP, bonds versus equities, bonds look good, bonds versus cash are looking good, looking better at least. So the valuation piece is there, but the conditions that got us here, it's the deficits, therefore increased supply. With good times maintaining in the economy, no recession, and an inverted curve. Now, it seems to me that you could be getting to the point where maybe 2 out of 3 could be shifting. So if the data starts to tip away from good times towards bad times, then there's no lack of demand for the increased supply. So where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Well, it takes a pretty big person to come on the show and say, listen, I've been wrong all the way up here. But laying out your stall. Good morning, Stephen, by the way. It's good to speak to you from New York.
Morning, Manners.
Term premium. I don't know the math. I'm not that intelligent, right? But you are. So term premium is turning higher, and this is part of the narrative for you. I know that. Is it rich enough for you to make a sort of a doubling down on your it is time to get long, or do you think you need to see more term premium before this market clears?
Yeah, so term premium is a symptom of something quite big happening. The last time we were writing about term premium was in 2014. That's after the taper tantrum, when it was really high. So that tells you something. So just to be clear, term premium's that additional bit of yield you get on top of what you would have had if you were just rolling bills. So it's the additional yield that you get from bonds as opposed to just holding bills through the life of that bond. Now, under most measures, it's risen by about 100 basis points, Manus, and that puts it back to levels of 15 to 20 years ago. So it's definitely more interesting. You are now being compensated to go into bonds, and I don't think you were so much before. So yes, the term premium is probably the signal of the capitulation. And if I go through these last 3 years where the yields have been rising, initially it was because the Fed and others were behind the curve, behind the inflation. Secondly, they doubled up and they went for 75 basis point hikes. You got a huge bear flattening. Right. And now the third stage has been the back end flipping, which is the term premium piece. So it could be that we're there, but you know, someone like me, I have to say these things very quietly now, because you come on this show, you say something big and you get hit immediately.